Hi guys! I've been investing for over a decade, and while I've made some solid moves, I've also made decisions that cost me money. At one point, I had to start my journey from scratch in my 30s. Today, I'll share my full investment journey with you, what I did right, what I did wrong, and how I invest now. This is my real, unfiltered investment journey, my experiences, decisions, and lessons that shaped how I invest today. This is Audz, your lobangs, who shares about personal finance so that we can huat together. Usually I talk about credit cards and I love credit cards, but today we're diving into something different, investments. The reason why I've been holding back about sharing this on all my social media is because I don't want people to follow me and then lose money. But I figured that I can share my experiences, my wins, and what I've learned over the years. Just a disclaimer, this is not a method, don't copy me, but feel free to learn from my journey. Before we start, help sis out by clicking like and subscribe, and I'll give you a heart in return. Who am I? A quick intro, my name is Audrey, I'm in my late 30s, I'm the only child in the family, and I currently live with my mom because my dad has already passed away. I have zero debts after paying my student loans, and I love traveling, especially now because I want to bring my mom while she can walk. When I got my first full-time salary, I started to learn more about investing in 2012. I wasn't some investment guru, but I had a very trustworthy and good friend of mine from JC who would talk to me about investments. He is a remiser and we still chat about investments. So he's kind of like my sounding board whenever I want to buy certain stocks, and that's how I've been doing it. But with that being said, we all started fresh and we didn't know much. So my first investment strategy was REIT investing for dividends. When I first started investing, I was heavily into REITs, real estate investment trusts, because I wanted some passive income through dividends. And back then I followed some investment bloggers who talked about REITs as a steady and reliable way to build wealth. In case you are a complete beginner, what are REITs? You can think of REITs like owning a piece of rental property, except that you don't have to deal with tenants or maintenance. Instead, you buy shares of a company that owns income generating real estate like malls, offices, warehouses, and even hospitals. And these companies make money from rental income. And when you invest in these companies, they pay you rent in the form of dividends. Over here, you can see that I bought some healthcare REITs like First REIT and Parkway REITs in 2013 because back then dividends was my goal. Why did I invest in REITs for dividends? Because it felt safe. Getting a payout regularly was reassuring, and the dividend yields were higher than a fixed deposit or savings accounts. During that time, I believed that it was a good way for me to generate passive income without active trading. However, because REITs have to pay out most of their profits as dividends, in fact, by law, they must distribute at least 90% of their taxable income as dividends to shareholders. As a result, they can invest very little into growing their assets. This means that their long-term appreciation is often slower than other growth stocks. And this was the first lesson that I learned. REITs give a stable income, but they reinvest less for future growth. I think it was a season where I understood the trade-off between REITs and growth stocks. And what financial studies have shown is that companies that reinvest, their earnings tend to grow faster because they can use the money to expand operations, acquire new businesses, or develop new technologies. And this is why many high-growth tech companies like Tesla and Amazon don't pay dividends. So does this mean that REITs are bad investment? No, but you have to know what you are looking for. It really depends on the company's industry and opportunities. If you want steady cash flow and income, REITs can be great, but if your goal is high capital appreciation, then focusing on stocks that reinvest their profits might be better. So after a few years, I read more and I realized that as much as REITs did give me good dividends and some even have capital appreciation, I wanted better long-term growth. I did take a few losses, but thankfully overall my investments were still good and positive, and I made around 3K with an initial investment of around 14K. I do understand why some people like dividend investing, especially when they're starting out in their investment journey, while others are older and they want to be more defensive to protect their capital rather than to grow their capital. By the way, if you're still watching, do you prefer dividend or growth stocks? Drop it in the comment section and let me know. During that time, I also invested in STI ETF, which is the Straits Times Index, which tracks the top 30 companies in Singapore like OCBC, DBS, Singtel, Keppel. It's a mix of financial, property, and government-linked companies. But after investing for a few years, I realized that STI ETF didn't really move much either. Unlike the US market, the Singapore economy is more stability focused. The second lesson that I learned is that STI ETF is stable but don't expect big returns. So I started looking outside Singapore, and that was when I started exploring US stocks, which offered more opportunities for growth. As I study about US stocks, I came across something that many new investors don't realize at the start, which is taxes. The US imposes a 30% withholding tax on dividends for foreign investor. And being in Singapore, it means that if a US company pays you $100 worth of dividends, only $70 reaches your account, while $30 goes to the US government. Instead of focusing on dividend paying stocks and losing 30% on that income to tax, I started to look at companies that reinvest their profits. This approach made more sense because if companies reinvest their earnings instead of paying dividends, they can grow faster. Over time, this can result in better capital appreciation as the stock price will reflect the company's expanding value. So instead of taking the money out of the business, they let it compound and grow faster. As I explore US stocks, I naturally gravitated towards value investing, a strategy championed by Warren Buffett. Warren Buffett emphasizes investing in companies when their market price is below their intrinsic value, ensuring a margin of safety. Wow, sis, very difficult to understand. Some more intrinsic value. So basically, intrinsic value is what a stock is really worth based on its financials and not just what people are willing to pay for today. Just because stock prices are high doesn't mean you should buy a stock. The approach that I prefer is to analyze the company's financials, competitive advantage, and management strength. If the fundamentals are strong, you can hold through downturns with confidence, knowing that the stock is undervalued. This mindset gave me more conviction in my investments, but just as I was more confident, my life took an unexpected turn. Between 2016 to 2020, I took a 4-year sabbatical, meaning that I completely stopped work and I had no salary and I had to pause on my investing. I went to the US to study and I sold my stocks in 2018 to fund my expenses. By the time I finished my sabbatical, my savings had almost returned to fresh grad level, which is almost zero. Because after all, in those 4 years of not working, I had incurred opportunity cost of the income that I could have made during that period, plus I had used up all my savings then. If you're starting out, you might find investing overwhelming or that you don't have enough money to make a difference. But let me tell you, everyone starts somewhere. When I first began, I wasn't an expert and I didn't have a huge portfolio. In fact, after my sabbatical, I went back to zero. I think the key is to start small, be consistent, and keep learning and get back on your feet. Investing isn't about getting rich quick. It's about building habits that set you up for financial success in the long run. My current investment amount is so small, and some people might even say, like that you also dare to share. But I think that our society places too much emphasis on who has the most money, as if that automatically means that they are the smartest investor. To me, I think what's valuable is being able to share openly even when you don't have the biggest portfolio. Because at the end of the day, investing is a personal journey and we all start from different places, and that's completely okay. So after my sabbatical, I restarted my investments and refined my strategy. With my salary, I set aside around 50 to 60% of my take-home salary for my investments. The past few years, my portfolio was split in ETFs and individual stocks, 50-50. One of the main ETFs that I was holding was VU, which tracks the US top 500 companies. However, I've decided to sell my VU holdings and move it to CSPX because CSPX does the same thing, but it is based in Ireland, which allows me to avoid the 30% withholding tax on US dividends. This means that my money can grow more efficiently over time. However, at the moment, CSPX only makes up 1% of my entire portfolio, while the majority of my investments are in individual stocks across US, Singapore, China, and Europe. What's next? I plan to invest aggressively until I hit 1 million in investments and savings. Then I'll shift to a more defensive strategy. For now, I'm also keeping cash on the sidelines to enter the market when there is a big correction. If you're new to investing, here's what you can do. Step 1, allocate a certain amount that you are willing to invest for at least 5 years and up. Number 2, open a brokerage account. I use IBKR as well as Mumu as my main accounts, which you can open an account with my link below to get some sign-up rewards. And number 3, start with index funds like CSPX and consistently invest every single month. So I have a question for you guys. How do you invest? And what are the lessons that you have learned? Drop a comment and I'd love to hear your thoughts. Before you go, don't forget to like and subscribe. And if you have found this useful, share it with a friend who might just be starting out on their investment journey. I hope this helps. Let me know what you guys think. Okay, thanks. Bye.